The Bears are gonna feast on Thanksgiving. It'll be the Bulls that have their day on Christmas.
Hi, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Well, we're getting into that time where everybody's just kind of sliding into the Thanksgiving holiday time frame. And then, of course, we know what's beyond that. We're in full-blown holiday season. We have Black Friday coming up at the end of this week. And that can have a lot of implications into the ag commodity markets and other markets as well. So things are getting really interesting now. And here on the final trading day before we take a Thanksgiving Day break, we have Joe Camp with us. He is with Comstock Investments, and we're going to talk about Wednesday's market activity. We had quite a few different signals coming out of the markets here on Wednesday ahead of the holiday. And Joe, first of all, I want to get your take on what you thought was maybe the most significant thing today.
Most significant would be the bean oil dropping as sharply as it did, almost 2% lower. You have a reversal of the strength yesterday. So, failed rebound attempt that sent these contracts right back down to test recent lows for the move. You have all that's going on with the political influence and relatedly biofuels and policy beyond 2025, certainly, but even before then, open questions, now maybe diminished confidence that the Biden administration will release guidance that should come from the U.S. Treasury before December 31st on the 45Z credit, that clean fuel production credit that would support low carbon intensity ethanol, further support the sustainable aviation fuel industry. We're not, again, trusting, as we've had so many delays in the past on rules guidance for these programs, that will get that. And that could mean that we have open to cancellation or dismantling by a new government. There are open questions too before the end of the year on whether the current administration, the current Congress would extend certain tax credits that are already open, including the one for sustainable aviation fuel. But the bearish move on soybean oil, the overall anchor for the soy complex again today, you'd think otherwise maybe beans would be able to rally on the other side of the market, which is optimism over export demand. Another couple of cargoes sold to China, some, I think, overall relief after the tariff talk was drummed up again. We got to keep a real close eye on the soybean oil market in particular.
So the daily chart looks really nasty on the soybean oil. Do you think that it's basically set up to test those lows that we made back in, what was it, early August, I believe?
Yeah, middle of August, we were down 37 cents. You have now testing the 40 mark. It would be a couple of month low just reached here this week. So that as much as it was a star for the complex leading into just basically 15 days ago, you now have it as a leader lower. And there's still a lot of reason to be optimism. I go back to the biofuel policy, and the uncertainty there is understandably bearish. But we could also be friendly on just the sheer data of consumption that currently we've been receiving. And that fits with the last NOPA crush report, for example. It was a record month for soybean processings last month, and yet soybean oil barely budged higher. And in part, it's because we've been exporting a bunch of it, actually now exceeding the USDA's marketing year forecast for soybean oil exports, just less than 2 months into the marketing year for that product. So we are using it. There is a ramping up source of demand, but at least in the current market, it catches the trigger on those computer algorithms in an otherwise thinner market like we have today, down near those recent lows. And again, it's the bearish linchpin, at least for now.
Well, you talked about the spread between soy meal and soy oil, how it, they really had a big spread change today here on Wednesday. But I'm looking at a daily soy meal chart, and that doesn't look like anything to write home about either, really.
No, and you can call that general unwinding as opposed to any clear bullish position being taken in the meal itself. So Similarly, across the soy complex, you're going to have the broader headwind from what we observe going on down in South America. You talked to Matthew about that, the conditions there, and that is inclusive of Argentina, right, which is such a huge meal exporter. They've got more of it here this season going forward. We would expect. We know about the uncertainty regarding some of the world's biggest buyers like China, other countries as well, trying to replace what they're using. Palm oil market is in turmoil. So we'll revisit these questions or these developments, certainly on the bean oil and these products driving the complex overall.
On the soybeans, the base component of that triad there, it looks like they have been in a descending triangle or wedge formation for quite a while, and they're just sitting right on the bottom of that right now. Is there a danger? I mean, if they go much lower, if they break out the bottom side, would that signal a new leg downward? Or do you think this is going to hold? Because we've been here about, 5 times already?
Yeah, that's right. But it is, as you say, a narrowing formation. When you have a congestion and a sideways trade for as long as we have now, you have the compression of volatility, some of these lighter volume trades that can actually eventually precede that breakout or break down, in this case more aptly, if we are going to skip down below these lows. We were looking at corn really for guidance on the bean move. It was like, well, corn was just at the top end of its recent range, testing potentially a new high for the move. And it might be what allows the soybeans to hold that broader low, and vice versa. Now, if the soybeans do clearly break that low, and we can see a taste of that this week, it's going to be a negative exertion of force on the broader grain space that now corn is going to struggle because of it, likely. And so we're seeing that. We haven't broken down to new contract lows just yet, but we know below those contract lows is a lot of thin air here that we could come down towards those. We keep thinking about 2019 lows, which are for soybeans below $8.
Well, and you mentioned the episode yesterday. In fact, I want to refer everybody back to that if they want to go back and catch that. When I spoke with our own president, Matthew Cruz, who actually has ties to farmland in Brazil. And we were talking about the status of the crop right now. And so far, all indications are that, it was a late start to the planting season, but they caught up, and so far the soybean crop looks fantastic down there on average. And the window is closing on our export potential here, especially with China. I mean, we're down to maybe a month and a half left. Otherwise, they'll start getting everything from Brazil, right?
That seems to be the view out there, and backed up by data like recent Chinese export purchases. Again, flashing a couple of cargoes, as mentioned, of soybeans sold to China, but it's still the case that they're expecting to have delivery before January, early February, when some of these new trade policies might be implemented. And beyond that, they know they've got the cancellation card that they can use, and or it'll be that time, February and beyond, we're filling the pipeline with a Brazilian bean crop that China knows they have close ties, even closer ties to now. Of course, President Xi just visiting his Brazilian counterparts and talking about how strong that relationship is. And you have the recent currency shifts that have favored business in Brazil over the U.S. So something needs to change with one of those parts if we're not going to be pretty quickly from here losing quite a bit of demand, at least for the season, and then uncertain about long-term when that comes back, dependent very well then on the policy and all that will still transpire now over these next several weeks.
Well, let me ask you this. There's been a lot of market talk about tariffs being imposed on China once again if we get the new president installed in January. But he has also threatened tariffs on Mexico and Canada as well. and they're big trading partners. How much impact would that have on things like maybe corn and on our wheat?
The impact there would be the risk of retaliation, the same as it is with China. You can have these announcements of tariffs that are going to, for Mexico, very heavily involve cars and car parts. Also, ag imports are important. Feeder cattle imports have been in the news related to Mexico this week, but they've been a huge deal all year long. The thought is the potential savior for ag is that ag is supposed to be fully exempted from tariffs under the USMCA. The Mexico-Canada trade agreement, having put into effect, potentially allows it so that we have tariffs against Mexico and Canada. They're going to find items to tariff as well. There's a strong need, though, as we know, for corn coming from the U.S. into Mexico. And just like China in years past, they step in the market when they need the corn or soybeans. So if they need it, it doesn't rule out them not having to retaliate using agricultural tariffs. They can, try to work towards a deal another way. We know that just recently the U.S. trade representative that helped work on the first trade agreement with China has been tapped by President-elect Trump to take that office. So, there's different outcomes certainly than what we went through the first time around, and the market's trying to reflect that in this back and forth each day when we have new news related on the tariff talk.
Well, just like on soybeans, the wheat markets have been trading close to, well, I don't know if they're contract lows or not, but long-term lows anyway. And it seems like they continue to test that, but do you think it's going to hold now?
As soon as we had some upside attempt for the Russian market, which had been such the dog for so long, dumping wheat into the world market and really pressuring prices, again, had some life in that market. The government came in, said we're going to have to try to put in a higher export floor, support the market that way, a temporary relief for this market that's ultimately, again, failed. You mentioned these contracts back down to their contract lows. That would develop not only from the retreat again on the Russian market, the calming of some of the tension that had flared up again with the war in Ukraine, but also just generally better conditions for wheat that's in the ground right now. And that includes the U.S. winter wheat crop, those condition ratings at a 6-year high. Better, of course, just generally for the moisture we've enjoyed over the last 5 weeks or so. But then also better conditions, better results coming out of the harvest in the southern hemisphere. That includes back down in South America with Argentina and also over in Australia. So just not a lot positive out there for the wheat to go on right now.
Let's talk about livestock a little bit. And on this final trading day before the Thanksgiving Day holiday, we had a lot of plus signs, a lot of green on the screen for the cattle market anyway, the cattle complex. And it seems like people try and cherry pick that market there and try and pick a top, and it keeps proving them wrong. It looks like it's going to sell off. It looks like it's going to turn technically, and then it just really never does it?
That would suggest the speculators are still very aggressively defending their net long positions that have been built up over the past several months in the livestock, and that would especially include cattle, that you have this buildup and then test now of recent highs. It's led by the feeder cattle. Of course, we had some news over the weekend, cattle imports from Mexico having a temporary ban because of a screwworm problem, a fly larvae that can cause infections. The uncertainty there, and again, just the simple shutting off of the flow of those feeder cattle imports from Mexico that have been so hefty lately. That was the bullish catalyst for that feeder market, ultimately helping lift the live cattle in defiance of what was last week on Friday, that kind of bearish leaning cattle on feed report. So yeah, speculators still on the gas pedal here, cattle. And earlier today, the hogs too, finally before the holiday break, they seem to be taking some profits. And I bring that up because relatedly, the speculators there are trying to withstand a little bit of top picking type of interest out there, and they hold a record net long, pretty close to it, at least on the hogs still.
Well, I'm glad you brought that up, because Friday is going to be a very important day in the ag trade. for several reasons, isn't it?
We've got a shortened session there. Sometimes you can have the traders still home for the holiday, lighter volume, but then higher volatility precede that. It just depends on those computer algorithms and how some of these support or resistance levels are tripped. Again, we've got a little bit more concern all of a sudden because the wheat and the soybeans are back down there to their lows. But on the flip side of it, we've got cattle and hogs that are not too far from being able to test really key resistance type points. And then fundamentally, it's this Thanksgiving holiday. We get past it, and we're starting to think about the seasonality of meat demand and wondering if the coverage for the holiday season has mostly been accomplished, setting us up for what can be historically seasonally some downside here into the year's end. But again, for now, no indication that the spec crowd at least wants to back off, and they're driven too by the fundamental bullishness that remains in both of those markets.
It'll be the last trading day of the month. Typically, don't you see a lot of profit taking on that day?
Yeah, you can see position squaring, profit taking, certainly, which could be more negative on a move that's been stronger, like the livestock, or it could be a little bit friendly, providing some relief for the grains after the last several sessions have been more negative than friendly.
Were you saying before we started our recording that it is going to be first notice day as well?
We've got first notice day on Friday, so it was today where we saw that last chance for the longs to exit before delivery, and that was seemingly evident in the December corn contract, which was down 4.5 cents more than the next up March. So you're getting those longs having to sell right before the bell, some of those being rolled forward into later months, keeping the spread trade really the most active component of this pre-holiday trade today.
Well, okay. So tomorrow there will be no trade. You said the ag trade is going to have an abbreviated session on Friday.
That's right.
We're not going to have a lot of time to get anything done between now and next week. And yet we have a lot of stuff in play right now. When it comes to geopolitical tensions, there's a lot of war risk, a lot of political tensions, not only around the globe, but here domestically as well about what's going on. Gosh, how do you ride out a storm like this? Because there's so much volatility potential in the markets in both directions right now. Are options a way to go, or what?
That might be the case, that you look at instruments that can position you for potentially higher volatility. If that's your view, and it's generally shared by me, just relative to what I feel like we're seeing in the markets directly tied to volatility. And we know volatility premiums are part of options, so that's part of the conversation here. But I'm thinking about what's the risk here going forward? And it's all those points that you touched on: the political outcomes, the biofuel policy, the trade policy, the economic direction, the interest rates, where the currencies continue to level out. All of those items, plus, like we say, the things we can't think of that can pop up. And that's how I want to approach my position for crop marketing, for livestock as well. I want to think about our risk points, and then a lot of times consider if I need to be hedged for potentially higher volatility in the wrong direction. If I'm holding a bunch of crop, do I need to have that downside floor in case things get ugly in the worst case? Vice versa, if you've made a bunch of sales, do we have some upside exposure to kick in if we are able to take big leaps to the upside after a pretty quiet consolidating period? So that encapsulates it pretty well. Like what you were saying, it's seemingly a quiet market, but there's so much going on, and that's where things can shift in a hurry. And we look for that, right away to finish the week in this shortened holiday trade, which can sometimes get wacky. It also gives us that guidance. If the bears are gonna feast on Thanksgiving, it'll be the bulls that have their day on Christmas, or some of those items that we watch for playing themselves out this week.
This has that feel that it's just like this big rubber band that's just being tighter and tighter and tighter, and it's building up a lot of tension there, ready to go, but nobody knows which way. So anyway, well, you explained it very well. Thanks again for that. And this is exactly why you specialize in helping people with their marketing plans, because you can walk them through some of the strategies that can help them protect their bottom line, especially heading toward the end of the year here. So thank you for doing that, Joe. A pleasure to talk to you. You have a great Thanksgiving, and we'll talk with you next week. Joe Camp of Comstock Investments with us. That'll do it for this episode. For Brianne Hendrickson, I'm Marlin Bohling. We'll catch you next time after Thanksgiving. Hope you have a good Thanksgiving holiday. Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.